depending on who your processor is, most of them are really just, they don't have any mental effort in the game. They're more of just, I'll upload the documents for you. So without a solid understanding of how to structure a loan, you will fail. And anyway, even here, it's clogging the system. It's putting too much work on our processors where they're having to go in and restructure these loans because they know how to. Anyway, this borrower had a decent credit score, right? It was right off the bat. She's got her auto loan. What's the most recent late payment on there, Adrian? Okay. And is that in the last 12 months? Right? That's a little bit of a concern. Put it down. Some more recent lates. Yeah, disputed account right here, but it's a zero balance, so not really a concern. Some more recent lates. So this loan was initially, it was understood that the borrower didn't have, so this is what we call marginal credit, okay? Because of how recent the late payments are. So this loan was actually denied because of how it was structured initially. So it was structured without any other positive factors contributing to it, right? And I think it had a gift initially too, with this. So this is this is definitely not the type. So what ended up happening, this loan in DU got approved eligible, and that's automated underwriting. But when you get an automated underwriting approval from DU, it says you're an approved eligible. That doesn't mean anything, okay? Because it's still up to the underwriter to say yes or no, right? They have to still be comfortable with the loan. So the way this loan was sent in was that the ratios were stretched, okay? High ratios, so the thing was over 50%, and no reserves. So after the loan was denied, I got the phone call where I found out that she had $30,000 in a 401k that was missed out, right? And so, and then the D-Rock credibility wasn't very good. So what we did is we restructured the loan, took the gift out, did it with own funds and reserves, and resubmitted the loan. And out of the loan was approved the business. We had to close this last month, but that's $275,000 an opportunity that there's several loans that come across from other banks where they were denied because of they're not doing that structure, right? So reserves, the person having reserves and getting rid of the gift funds is the key points that I want you guys to take away. Do not combine a gift with marginal credit, okay? And about, I don't know how many FHA loans we're getting right now that have gift funds with marginal credit. It just doesn't, even though DU said it was an approved eligible, the underwriter has to be comfortable with it. So their perception really is what matters, not what you say, not what the rules say. That doesn't matter. What matters is how comfortable you can, if you can give them that feeling of comfort, okay? Let's look at another one real quick. That was marginal, right? She had some open trades. There's this guy. This is a USDA loan. I don't know what state it's in, but the score looks good. So when you pull up credit, you probably get happy. But when you look at the credit report and you talk to the borrower on the phone, you realize that you didn't ever really have a loan, okay? And it's going to take a great amount of effort to get a loan out of this. At least the way it was initially designed. Okay, so look at the trades. He's got a few active. How old? What's the oldest trade line here?
11 months.
11 months.
Yeah.
Okay, this is a USDA loan. What do we know about USDA's rules? You need what?
We need 2 trade lines of 12 months or more.
Okay, that's good. In order to avoid what?
A manual.
And when you don't have those trades, what happens?
It's manual underwrite. It's hard.
Okay, it's a manual underwrite. But what do you need to be able to supply? Because you have a lack of what this is called traditional credit. You have a lack of.
Oh yeah. You need all.
What do you need?
All the trade lines.
And how many?
At least 2. Well,
12?
no. So based on this, probably 4, right? 3, 4.
You need if you don't have rental verification that you can supply, you need 4 for 12 months.
Okay.
Okay? If you have rental, it's 2 plus rental being third. So rental being 1 and then 2 other ones for 12 months. So far, this person doesn't have any of those. Okay? Now we have a loan that we need to figure out how are we going to get this structured correctly. Now, if I was a loan officer on this deal, if it was me, at the time that I pre-qualified the borrower, what I would have gone over with them is seeing if do you have any accounts that maybe you could get added to, or do you have any money that you can get to go FHA? Because this would have been if once I talked to him on the phone at the time I was pre-qualing this guy, Jason. Once I talked to him on the phone and I was pre-qualing him, and I talked to him, and I was like, okay, you want to do USDA? And I'm looking at your credit report right now, and I see you don't have the credit. Now let me ask you this: what type of alternate credit do you have? And he says, well, I have electric. You go into it with him, and you say, well, how long? I would say, how long have you had those? 3 months, 4 months, 6 months. That's a problem. He has nothing for 12 months. So then I would have known right there at that time, at that moment, before I sent him his pre-qual letter, that he didn't qualify for a USDA loan, at least at the present time. He needed a little work. So the goal is that we're going to take this as an opportunity to learn, and I'm not saying I expect you guys to know this, that's why we're doing this, is to instill this into you, right, and give you the skill set, so that way when you're on the phone, you're asking the right questions and determine if that person actually qualifies for the program that they're going to be on.
Wait, so you said if they don't have rental, they need 4, or if they do?
If they don't have rental, they need 4.
If they do have rental, then what?
2.
Then 2.
2 plus rental, and it's for 12 months.
So if they have rental less than 12 months, then it's in 4.
Right. Yeah, or you get previous rental. But it's this is a good learning lesson. That's but you got to take on your mistakes. You have to learn from them. You have to improve. You have to become sharper. And this guy doesn't really have any derogatory credit, so I wouldn't really call this. This isn't something we would call marginal. Marginal is for people that have derogatory credit. A lot of derogatory credit. This is what we call thin, right? Thin meaning that he doesn't really have much going on there. It's like not many accounts, not really seasoned trades. This is a really thin credit profile. Okay, and that's a concern when you're doing a USDA loan. Otherwise, the score is good. If this guy was doing an FHA loan, you could close it no problem. As a USDA loan, it's going to take a little more work.
So this was a kid coming out of college, USDA.
He's a guy coming out of prison.
Oh no.
So he's close. you can do him.
He got his degree in prison.
Yeah, it was freedom.
All right. So that's. Let me show you another example. So you saw a marginal. You saw a thin profile. You kind of have an idea how to define those, right? In your mind. If you haven't before, to really know what those definitions are. What's up, man?
Oh, no.
So let's take a look over. We're going to look at another one.
A question on the rental real quick. How far back, let's say if they have rental in the past, but they're currently staying with family, how far back?
6 months. Has to be within 6 months to use it.
Okay.
So if somebody vacated, let's say that guy right there left, he would say, you know, he left his mom's house, you know, or he went to go move with his mom 2 months ago. He was renting an apartment for 2 years. Follow, Adrian? Follow? Nick Caputo? Okay. Let's say he moved out of his apartment he was in, he was living on his own for, you know, 2 years or so, and he moved out 2 months ago. He was getting a USD loan. You can use that rental as long as it's within 6 months that he from the time he vacated. And the same with any other alternate trade line. Okay. All right. So this is a file that we're working on. It's an FHA loan. This is the example that I brought to you guys. This is a guy that got a gift. And remember, just because you enter in a file in your 1003, just because you have a 620 credit score or whatever, and you enter in gift funds, now you think the down payment's covered. That doesn't mean it's a done deal. And if you ran it through DU and it says it's an approved eligible, that doesn't mean it's a done deal. Because what we have is when we combine marginal credit with gift, that's like an extreme concern, like the feeling that Nick had when he was going to lend Priscilliano money. Okay, that's an extreme. When you're doing that, you should be very careful to not combine derogatory credit, marginal credit, with any other negative risk factor. Okay, it's very important that you look at these things seriously. So take a look here. This is a 610 Florida score.